So we had a question about stock splits and why or why not to split them. And so Amazon, for instance, $1,822 traded up as high as 1834, and one of the big firms just came out and gave it a $2,100 price target. The other big one is Berkshire Hathaway. I can't think of the symbol off the top of my head right now, but it is around 122,000 or something like that. I remember in 1982, before most of you were born, no, it's 1980. Yeah, it was around 1984. Berkshire was trading at $1,200 a share, and one of my colleagues was buying it, and I thought he was crazy. And now it's trading at 122,000. And he's not a believer in splitting the stock either. So there's two theories or two thoughts on splitting the stock. One of the reasons you would there's several reasons why you'd split a stock. One of the reasons, of course, is to allow a wider, diverse population to buy the stock. Not many people can buy an $1,800 stock. You buy one share, it's $1,800. But if you split it, then it's trading at $18, or it's a lot more people can participate in it. And so you get a much bigger shareholder base. Now, for huge companies like Amazon, and I'll get into why you may not want to split it, it doesn't make that much of a difference because they have 402 million shares outstanding and $884 billion market cap. So what do they care who buys their stock or doesn't? And so, it's not split. But the smaller companies that are looking to finance their companies, they need maybe retail investors or, smaller institutions, they'll split their stock so that they can get a wider wider shareholder base and get a bigger shareholder base. But there's also, that also brings in, an additional effect for that. And that is, the lower the price, in the sense of you're trading at $10 or 20 or 30 instead of 2,000, and you need to do a financing, you can attract a more diversified clientele to take down your financing. And normally a forward stock split versus a reverse stock split, say a 10 for 1 or 5 for 1 or 2 for 1, in effect, it doesn't do anything to the company, to the share price, because let's say, for example, let's find the stock. Well, this one here, this GBTC. They split this stock a 1 for 100. This was trading at 11,000. Now it's trading at $11. So when you split a stock on a forward split, so 100 for 1, quite often or mostly the stock price in relative terms goes up. So if this was trading at $10,000 on the day of the split, and it opens at 1060. In effect, it really is trading at 10,600, but it's only a 60-cent move on a $10 stock. But those people that had bought it, it's a $600 move for them. So it's a huge move. So quite often a stock split is a bullish sign. It was far more prevalent in the past. Splitting the stock is not as prevalent anymore, and then there's reasons for that, but I'll get on the con side in a second. So when you split a stock, quite often it goes up, or just before you split it, quite often it goes up. You get a wider variety of people. You maybe becomes more attractive for more people to buy it, and so you get bigger liquidity. And if you are a CEO and you need liquidity to sell your paper, then it's always good to have more people in there buying and selling your stock, and you can participate in that. So that's sort of one of the reasons why you do split it. Now, there's lots of reasons why you don't split it, and that is for exactly the same reason that you do split it, except the inverse. You may not want those type of shareholders in your deal. You might just want institutional investors, and because they don't care about financing price, because they have huge pools of capital, so they could trade it, and they want to, so you want to keep your shareholder base tight. You want to keep, and the price goes up. So you don't want, certain people that you don't want involved in your stock, or certain shareholder types, because at shareholder meetings it can just cause you nothing but trouble. You've got regulatory, issues. You've got cost. There's a cost to doing a stock split. So there's many factors why you don't do a stock split, and there's many factors why you do a stock split. So, Elliot Davis, to answer your question, nowadays it's a 50-50 deal. There's pros, there's cons. There's no particular reason why a company does or doesn't. I mean, each time a company wants to do a split or not do a split, it's their own. They have their own reasons for it. It used to be a very common thing when a stock got to 100, you split it 10 for 1, so it started again at $10. And that was the common theory and the common thinking. Nowadays, that thinking has gone out the window, and each company is individual, because there are a lot of regulatory hurdles that have to be accomplished, and there's a big cost for it, especially the bigger your company is. There's big cost to doing stock splits. And with investors now versus day traders, investors now buying mutual funds or buying ETFs, they're not really looking at they're not really looking at they're looking at the price of the ETF, and the ETF's got all the money, so they don't really care what the price is as long as they get the percentage gain, the percentage move gain on it, on the money that they have invested. So that's the theory of stock splits. Hopefully that answered your question.